Next, we will talk about the operating income. The reporting of revenue and expenses is important, but profitability is very important. And operating income tells you what income you generate by the operations you do. And there are two profitability measures. Operating income measures economic profitability as defined by the GAAP, and the focus is on patient service activities. So every time you provide a service to a patient, whether it is in the form of a surgery or a procedure or an outpatient visit, you generate some revenue. It can also be in the form of, let's say, the patient went and bought something at the gift shop, or they came to the hospital and parked the car, and they had to use the parking lot, and they paid a parking lot fee. So all of these things that generate revenue and are directly related to patient service activities is known as operating income. It is an important measure of profitability because patient services represents the organization's core business in healthcare. Um, the focus of any hospital or healthcare organization is to provide patient care. Now, there is some non-operating income which comes from contributions and investment income. Let's say, you generate some revenue and you have taken $100,000 from your revenues from your medical clinic and invested it in stocks or bonds or US securities. So that is an investment and that is generating you $3,870 of investment interest, or I mean, interest or dividend through that investment in the year 2020, and approximately $3,600 in year 2019. Contributions are the donations or contributions that you get from other organizations, and that is, like people will donate. Let's say they come and they donate $50 to your hospital. So that's amounting to $243 for the whole year 2020 and approximately $200 for 2019. So the total non-operating income for 2020 is $4,000 for Sunnyvale Clinic and approximately $3,800 for Sunnyvale Clinic in 2019. So, what do you understand by non operating income? That reports income from activities that are not related with patient services. So, contributions that are coming from donations, like I already told you, that can be immediately spent. But contributions that create endowments are not reported on the income statement. If there is a trust and the trust says that for the next 10 years, this hospital will be getting, like $500 every year, and in order to get that endowment, they have to meet certain criteria. So those are not contributions. Contributions are mainly cash donations, and that can be immediately spent. Investment income comes from excess cash that is held or as reserves, or you need, or when you use that cash to invest on endowments, and you get dividends from it, and you get equity from it. That is investment income. So the Sunnyvale Clinic's net income is a total of operating income and total non-operating income. So as you can see, the net income is approximately $6,000 for 2020 and $8,000 for 2019. Now the second measure of profitability is also called as the bottom line, is the net income, which we just saw on the previous slide. So the net income measures total economic profitability, and that is how it is defined by the GAAP. For a not-for-profit business, net income includes revenues over expenses, excess of revenues over expenses, and change in net assets. So if you minus the expenses from the revenue, that is a net income, and that is for the not-for-profit business. Income statements and profitability. The income statements of many not-for-profit corporations, they have a section below the net income line, and that reconciles net income with the balance sheet, and that is net assets account. So you have to note that economic profitability is a complex concept that is very difficult to measure because economic gains and losses are not matched by easily identifiable and measurable statement events. So there is a comparison between not-for-profit and for-profit organizations when it comes to net income. In a not-for-profit organization, the entire amount of net income is reinvested in the business. It is not given to shareholders. But for a for-profit, the net income constitutes the residual earnings of the business, and that belongs to the owners, that belongs to the shareholders or the stockholders. Some portion of net income may be returned to owners as dividends, like it's paid out as dividends, and then the remainder is reinvested in the business itself. Because of accrual accounting, you remember what accrual accounting is? Accrual accounting is when you have some outstanding receivables from patients or patient service activities and you have not received it yet. However, cash accounting is when you have already received the cash. Now, because of accrual accounting, net income does not represent cash flow because the cash is not there yet. Some income statement items represent cash flows, but others don't. Um, Revenues can represent partial cash flows. Now, with only income statement data, cash flow can be approximated by net income plus non-cash expenses and net income plus depreciation. And in the case of Sunnyvale Clinic, it is $14 million. Now, income statement summarizes activities of an organization with a focus on revenues, expenses, and profitability. The investor-owned and not-for-profit businesses have similar income statements. The revenues and cost to organizations are in the same line of business are similar, and the ownership does not matter there. However, some transactions such as income tax payments are applicable only to for-profit businesses. So the line of business differences have a greater impact on financial statements than the ownership of business. Impact of depreciation expense is on cash flow. So depreciation represents the wear and tear on property and equipment. So on this slide, you will see that for the not for but cash flow is equal to net income and depreciation, and the amount of taxes that is saved by depreciation is called the depreciation shield. So in this particular slide, you will see that there is total revenues and expenses. Now, when they have written the line item expenses, they have removed depreciation from there. But then they have included the depreciation line. See the brown bold line? That's the depreciation line. Then there is a line of total expenses, and then there is taxable income, right? So when you have the revenues, all you have all of the expenses, which includes the expenses and depreciation. You minus, and then you have total expenses, right? So you take the $166,000 out of the $174,000 and you get a total of $7,860 in taxable income. So let's say for not-for-profit the taxes are zero, so the net income will be 7,860 and the cash flow is $14,265. For profit the tax is 20%. So the 7,860 that they make as taxable income, they are charged 20% tax on it. So they have to minus that in order to get the net income as $6,288. And for profit, which has a tax of 40%, the 7,860 is still the same, right? But you are charged a 40% tax on it, which amounts to $3,144 in taxes, and that leads us to a net income of $4,716 for the for-profit. Now, let's say there is a for-profit which has a 40% tax but does not have any depreciation. So the depreciation is zero. So now the taxable income is high because you minus the expenses from the revenues, but the depreciation is not included in it. It is all expenses but depreciation. So the taxable income in this case is $14,265 with a tax of 40%. So 40% of taxes on $14,000 is $5,706, which gives you a net income of $8,599. Okay, and their cash flow is $8,559. All right. And how did we calculate the cash flow? It says in the notes on the right. It's a addition of net income and depreciation. So if you look at the first column again, net income is $7,860 and they added the depreciation to it, $6,405. So that gave a cash flow of $14,265. Now, the taxes are being saved by depreciation because you're writing it off as depreciation, and that is called the depreciation shield. You say that I bought a building, but that's depreciating with time, and because it is depreciating, I do not owe so much taxes to the government, and therefore they will give you some tax deduction on the depreciation, and that is called the depreciation shield. So Sunnyvale Clinic's statement of changes in equity is shown here. The net income is as shown for 2020 and 2019. Equity at the beginning of year is $46,208 and $38,000 in 2019, and at the end of year is $54,000 because you add the equity to the net income, right? And you get that amount. So the beginning of year equity values are taken from the balance sheet, and that is going to be discussed in the next chapter. So the statement of changes in equity reconciles the income statement net income item with the balance sheet equity account. When you have the income statement, you have the net income, right? But when you have the balance sheet, you have the equity. So the statement of changes in equity is basically reconciling the income statement's income, net income, and the balance sheet's equity together. So for a not-for-profit organization, the entire amount of net income flows into the balance sheet um, because you don't have to pay your owners or the stockholders. Also, the statement often is affixed to the bottom of the income statement rather than presented separately. But for a for-profit business, there are the deductions to net income, which are often known as dividends, and that reduces the amount that actually goes or flows into the balance sheet. Here is a little bit of introduction to the financial condition analysis. In financial condition analysis, values from the financial statements are used to make ratios, and those ratios help us interpret the economic meaning or the financial status of the organization. For example, if you want to understand what is the total profit margin, then we take the net income value and divide it by the total revenue. And so in the case of Sunnyvale, let's go back for a second here. The net income was $7,860. If you see here or even a little bit back, net income for Sunnyvale Clinic, and I think they have not taken the figure 6394 or 8206, but let me just